Tax Tips Tuesday on 105.9 The Region.
With tax season just around the corner, KPMG is here every Tuesday with Tax Tips Tuesday. To help us get us started is KPMG and Canada's tax partner, Joseph Pagliaroli. Welcome back to 105.9 The Region. Joe, how are you?
Not too bad, Jim. Glad to be back.
Excellent. So we're here today to share some tax tips for small and medium-sized businesses.
Yes, and I'm going to get right into it, Jim, with my first tip, which is making sure that you pay your taxes on time. Corporate tax liabilities are due either 2 months after your corporate taxation year end or 3 months if the corporation is considered a small business. Remember, too, that if your total corporate tax liability is greater than $3,000 for both the current year and either of the 2 preceding years, you'll need to make tax installments for the current year as well. These are due monthly or quarterly, depending if you're a small business. And CRA will charge interest if you make late or insufficient payments, and this can add up real fast. Even if you filed your corporate income tax return by the due date, you may be assessed additional interest if these payments aren't made by the deadline.
So it definitely pays to pay your taxes on time.
Oh, absolutely. Which brings me to my second tip, Jim. Ensure that you're not faced with arrears and tax interest on your year-end corporate tax payments. You should estimate these amounts of taxes you need to pay and ensure that you pay by the deadline. Any overpayments will be refunded after you file your corporate income tax return.
Which leads me to my next question. What if you miss an installment?
And Jim, that's my third tip. You can reduce or eliminate interest and penalties on late or insufficient tax installments if you either overpay your next installment or pay your next installment early. This will allow you to earn installment credit interest, which is non-refundable, but which can be used against any interest charges on late payments for the same tax year.
That's great advice. Any other tips, Joe?
Yeah, so my fourth tip is that many of the benefits that you give your employees are also considered taxable. So they need to be included on the employee's T4s and are subject to payroll deductions. You'll want to check with your tax advisor or CRA website, but some examples of taxable benefits are some insurance premiums if the corporation pays them, parking, and company vehicles that are also used for personal use. The fifth tip is to consider the tax implications when timing your asset purchases and sales. So for instance, if your corporate year-end is approaching and you're anticipating buying a depreciable asset, you should consider buying them before the year-end because most of depreciable assets acquired in a taxation year are subject to preferential tax depreciation regardless of when in the year you actually purchased them. And similarly, if you anticipate selling any assets near the end of the corporate taxation year, you can defer the taxes on the gains of these assets for a full year if you push the selling date to after year-end. And Jim, finally, my sixth tip, don't forget to use the small business deduction if you're eligible. This is a reduction in corporate taxes for Canadian-controlled private corporation that is available on active business income up to the corporation's business limit for the year, which is currently $500,000.
So I take it that you should consult an advisor if you're going to use any of those.
Absolutely, Jim. That's a very good idea. There are specific rules and conditions for most of these.
As always, thanks for the tips, Joe. We'll talk again next Tuesday. If you missed this week's or last week's Tax Tips Tuesday, go to our Twitter feed at 105.9 The Region or, as always, kpmg.ca.
Tax Tips Tuesday with KPMG in Canada on 105.9 The Region.